Good afternoon. I'm Keith Fitzpatrick, and this is a presentation on credit rating agencies, their major shortcomings, and possible solutions. This presentation will cover the role of credit rating agencies, the rating systems that they employ, how those ratings are utilized, and a brief history of the credit rating industry. I will then go through a study that I conducted of credit rating agencies and present my results and analysis. I'll then continue with the four major shortcomings of credit rating agencies, including credit rating agency failures, lack of accountability, lack of competition, and conflict of interest, before finally concluding with the future of credit rating agencies. The rise of investment across industries and national borders has created a need for the quantization and standardization of credit risk. Credit ratings provide informed and standardized opinions on the creditworthiness of an obligation and indicate the probability that the obligation will be repaid. If functioning properly, credit rating agencies can warn of impending danger and allow both investors and issuers to modify their actions appropriately. Each of the three major credit rating agencies has their own rating system, but all three are very similar and can be roughly correlated as shown in this table. As you can see, these ratings run from high-quality investment grade through speculative with substantial risk, all the way down to default. While a specific criteria isn't important to this presentation, it is worth noting how similar the ratings are to each other as we discuss the industry's lack of competition. Along with providing these ratings, credit rating agencies can also provide outlooks and watches of possible ratings changes. This information can be just as valuable to investors as the ratings themselves. These ratings are utilized in a variety of different ways, and there are several sources of demand for the products that credit rating agencies produce. The first is that it reduces conflict and offers common ground between issuers and recipients of credit. A second source of demand comes from organizations which have policies that prohibit investment in speculative or non-investment grade assets. Demand also comes from those parties who use the information to make business decisions regarding interactions with a rated company. These could include parties that are evaluating trade relations or entities considering entering into a joint venture. Another source of demand comes from those small investors who do not have the resources to be able to independently assess the copious amounts of data regarding an investment. For these users especially, it is important that credit rating agencies accurately reflect the risk of an asset. In fact, many markets do not allow financial transactions without these ratings being in place. As we discuss credit rating agencies, it is important to have a historical context of the development of these institutions. The history of credit rating agencies has led naturally to some of the fundamental flaws in the ratings industry. Credit rating agencies began at the turn of the 20th century with Moody's as the first company to begin rating bonds. In 1909, Moody's published its first credit rating by providing an analysis of railroad bonds. The companies that merged to create Standard & Poor's began rating companies in 1916 and 1922. Fitch, who makes up the third in the Big Three, was created in 1924. These three agencies have dominated the industry from the beginning. From the 1930s to the end of the 1960s, the credit rating agency was characterized primarily by mergers and consolidations. In the 1970s, the industry began to go through some drastic changes. As a result of increased financial pressures, it was at this time that they determined they could substantially increase profits by shifting to an issuer-pays compensation model. It was also at this time that U.S.-based credit rating agencies began looking abroad to the global market as the path to future growth. To test the effectiveness of credit rating agencies and whether they were a good predictor of an asset's performance, I conducted a study of the performance of 15 stocks chosen at random from the Dow Jones Industrial Average, and then looked at the stock's performance in the 6 months leading up to and the 6 months after a rating actions by the credit rating agency Moody's. These were all large companies with lots of data available, and Moody's was chosen since it's the oldest, largest, and arguably the most prestigious credit rating agencies. Moody's has 5 different possible actions to take regarding a rating. They are downgrade, possible downgrade, confirmation of a rating, possible upgrade, and upgrade. The gauge of performance was the rate of return. The formula used to calculate the rate of return should be familiar to all IE590 students. The results were surprising and are shown here graphically. The brown bars are the stock's performances before a ratings action, and the blue bar is the stock's performances after a ratings action. From left to right, you're looking at downgrade, possible downgrade, confirmation, possible upgrade, and upgrade. From the graph, it is clear that the stocks that performed the best were those experiencing some sort of ratings downgrade. The null hypothesis, assuming rating agencies were performing their functions properly, was that the period after a downgrade or possible downgrade would see poor stock performance, and the period after an upgrade or possible upgrade would see positive stock performance. What we got was the exact opposite. Stocks performed the best after a downgrade or possible downgrade, and only mediocre after an upgrade or possible upgrade. From this, it appears that credit rating agencies look more at past performance than at the potential for future strength. Given my simple study, it is not hard to imagine that the industry has experienced multiple and disastrous failures, and since the late 1990s there have been serious concerns about their reliability. The Asian financial crisis of 1997 and the collapse of Enron both showed examples of highly rated securities that defaulted quickly. More recently, the subprime mortgage crisis has highlighted the serious shortcomings of the ratings process. The pre-crisis environment saw credit rating agencies operating largely free of any substantial government oversight. Before the crisis struck, credit rating agencies had given high credit ratings to securities backed by risky subprime mortgages, which quickly collapsed during the crisis. The conclusion of the Congressional Financial Crisis Inquiry Committee, FCIC, was that credit rating agencies were essential cogs in the wheel of financial destruction. Even with these well-publicized failures, there is almost a complete lack of accountability by the credit rating agencies. Rating agencies have been able to successfully argue that their ratings fall within First Amendment protections. This means that legal action, or even regulation, could be considered unconstitutional. Those parties wishing to pursue legal action for misleading information must first prove malicious intent. This legal judgment has been upheld in multiple cases, including cases like Orange County's lawsuit against Standard & Poor's and plaintiffs wishing to pursue claims in the wake of the Enron collapse. The industry's lack of competition has created a self-perpetuating oligopoly where a credit rating agency's reputation and size is the primary factor in capturing market share. Together, Moody's and S&P capture 80% of the market share. If you add in Fitch, that market share of the Big Three jumps to 95%. The Big Three have been granted privilege status by government agencies who use the ratings for regulatory purposes. This oligopoly makes it possible for the dominant agencies to restrain entry into the market in order to retain their market share. The Big Three also use their collective clout to stop unfavorable legislation. States wishing to restrain credit rating agencies have seen their financial markets essentially shut down by these behemoths, as was the case with New Jersey when in 2003 it passed the Home Ownership Security Act designed to stop dishonest brokers and predatory lending. The issuer pays business model adopted in the 1970s by the ratings industry has created inevitable conflicts of interest that continue to make the ratings process suspect. In a subscriber pays model, investors pay for ratings information, allowing them to make sound investment decisions. Unfortunately, once that information has been released, there's little a rating agency can do to stop it from being passed along. Credit rating agencies realize that they can substantially increase their revenue by shifting to an issuer pays model where the issuer of the debt pays to be rated. Under this model, rating agency customers are the very same companies that they are supposed to be rating. Customer satisfaction relies on high but inaccurate ratings. Rating agencies have also begun offering additional consulting services to the companies that they rate. This introduces another source of conflict. The consulting services that rating agencies offer are essentially trial runs of the rating process where companies can experiment and exploit the ratings model with the agency's help. While savvy investors certainly take into account rating agencies' problems, the sources of demand for accurate credit ratings are not going to diminish. And despite failures and shortcomings, government agencies are relying on these ratings more, not less. If credit rating agencies are here to stay, some possible improvements to the industry include the following. First, increased government oversight and insistence on transparency and standardization of ratings. Second, limiting credit rating agencies to only providing ratings would at least remove that conflict of interest. Third, creating a central government clearinghouse that randomly assigns rating agencies to new securities would put less pressure on credit rating agencies to provide high ratings to maintain market share. Taking this independent government agency approach one step further, some proposals, particularly in the European Union, call for the creation of a government-run credit rating agency. In theory, a public credit rating agency would introduce more competition and see none of the conflicts that private agencies do. Of course, none of these options are perfect, and all are sure to be met with by resistance from the ratings industry. In summary, here is a list of topics that we covered during this presentation. Thank you for your time and attention. If you have any questions or comments, please email me at fitzpat2@purdue.edu.
Hello everyone, my name is Jason Warren and I'm here with Chris Goosen and Daniel Walker, and we're going to be discussing the student debt crisis. We'll first start off talking a little bit about the student debt crisis and the issues that have caused the student debt crisis. We'll then talk about current legislation within Congress to address the issue, and finally we'll talk about implications that this crisis could have on the economy. I would like to welcome Chris to talk a little bit about the student debt crisis.
Student loans can either be federally backed or offered by private financial institutions. The majority of student loans are federally backed, with the most common type being Stafford loans. Stafford loans could be subsidized or unsubsidized loans backed by the federal government if the student defaults. Nearly all students are eligible, and acceptance is not based on creditworthiness. They are currently offered with an interest rate of 6.8% with no payments due while the student is enrolled in school. Each student is allowed a maximum of $57,500 of Stafford loans. For students with higher financial needs, the federal government also offers federal Perkin loans, which are distributed by the U.S. Department of Education. They are currently offered at a 5% interest rate with no payments due while the student is enrolled in school. Currently, students are allowed to take a maximum of $27,500 in federal Perkins loans. As an alternative to federally backed loans, private call-out loans are also available to students. Interest rates vary greatly based on the creditworthiness in the terms, but are typically higher than federal loans. Private loans also commonly lack protections of federal loans, such as unemployment deferment, and generally require students to make payments while enrolled in school. Roughly $864 billion in outstanding federal student loans exist, and $150 billion in private student loans exist. Among all 2007-2008 bachelor degree recipients, 66% graduated with some educational debt, and 10% had borrowed more than $40,000. 62% at public four-year institutions had borrowed, while 96% at private for-profit institutions had borrowed. As of October 2012, the average amount of student loan debt for the class of 2011 was $26,600. Which is a 5% increase from approximately $25,350 in 2010. It is important to note that neither federal nor private loans can be discharged through bankruptcy unless undue hardship exists. These conditions are when a student would be physically unable to work, likely to be unable to work for most of their loan term, or paying would prevent them from maintaining a minimum standard of living. The increased student debt has been driven partially by an increase in college tuition. College tuition has risen since 2002, approximately 45% for public colleges and 25% for private colleges, compared to the average inflation rate over the same period of 2.5% per year. In addition to carrying higher student debt, students are also facing challenges due to the impacts of the recent recession. In April 2012, 1.5 million, or 53.6%, of bachelor degree holders under the age of 25 were jobless or underemployed. In 2000, only 41% were jobless or unemployed. As a point of comparison, unemployment rate for 16 to 19-year-old Americans in 2011 was only 20%. In addition, in 2012, college-educated men and women entering the workforce saw their inflation-adjusted earnings fall 5.2% and 4.4% respectively.
My name is Jason Warren, and I will be discussing the current legislation in Congress to try and decrease the impact of the student debt crisis. We'll be talking about a currently enacted plan, which is the pay-as-you-earn plan, as well as 5 different proposed plans. One is proposed by President Obama. There are 3 proposed within the House, 1 Republican plan and 2 Democratic plans. And there is 1 plan currently in the Senate, which is proposed by a Senate Democrat. The pay-as-you-earn plan was enacted by President Obama in 2012. It was his first measures as president to address the issue of the student debt crisis in America. The plan limits repayment to 10% of discretionary income. This was done to try and maintain an affordable monthly payment for individuals who graduate with student debt. Loan terms were capped at 20 years for up-to-date borrowers. If you haven't missed a payment, after the 20 years, the balance of your loan will be forgiven. There's been much debate about the pay-as-you-earn plan and its impact on the student debt crisis as a whole, but there are some obvious pros and cons to the plan. Pros are that the plan limits monthly payments to manageable amounts for all individuals with these types of loans. There's also a cap on the length of the loan, and debt is forgiven after 20 years of on-time payments, which for low-income earners who have not been able to pay off the entire debt within 20 years is very beneficial. Cons to the plan are that it is only eligible for federally backed loans, not private loans, which we know make up a large part of student debt. Also, these loans must have been received in or later than 2011, which means that for all individuals that are currently suffering through student debt, it is not going to have an impact on them. The first plan that we'll be discussing that's going on through Congress right now is the Obama plan. Now, Obama's plan is based on setting rates on the 10-year Treasury note. He has it distinguished between need-based and not need-based loans that will be determined by FAFSA. The need-based loans are the 10-year Treasury note plus 0.93%, whereas the not need-based loans are 2% higher at Treasury note plus 2.93%. The benefit to this is that these are fixed-rate loans. You don't have to worry about market volatility later on in life. And also, Obama's plan has no impact on the federal deficit. He has made it very clear that he does not want the government to be profiting from students to decrease the deficit. He wants it to be a wash. Similar to President Obama's plan, the House Republicans' plan is based on the 10-year Treasury note. There's no distinction between need-based, so all individuals will have loans at 2.5% plus the 10-year Treasury note. These are adjustable rate loans, so they will fluctuate throughout the length of the loan based on the 10-year Treasury note. The House Republicans also propose an interest rate cap, which is set at 8.5% for Stafford loans and 10.5% for parent and graduate student loans. This will have a reduction to the federal deficit of approximately $10 billion over the next 20 years. House Democrat Plan Number 1 is the least comprehensive plan going through Congress right now. Their plan is to extend the subsidized rate of 3.4% for the next 2 years. Now, this will come at an expected cost to the federal government of $8.3 billion, but they plan to cover this cost by closing tax loopholes. These are fixed-rate loans, and the idea is that this will provide Congress enough time for a comprehensive student loan overhaul rather than just a quick fix like they believe is being proposed. House Democrat Plan Number 2 is the most comprehensive plan going through Congress right now. The idea behind this plan is that individuals will pay 10% of their gross income for the next 10 years. At this point, the remainder of all debt will be forgiven. The plan also allows for the consolidation of private loans and federal loans. This plan eliminates the need for any interest rate conversation. The Senate Democrat plan is to propose fixed rate loans. All federal loans will be at a 4% fixed rate and will also allow graduates who are currently paying down higher interest loans to refinance at 4%. This will also have a future interest rate cap of 5%. However, there is no term limit and there is no debt forgiveness. Within media outlets, it is believed that House Democrat Plan Number 2 has the most potential change for the student debt crisis. It's the 10 for 10 plan, so there is a set term on all loans, as well as a set percentage that individuals will be paying back. It's the most comprehensive plan that's being proposed right now, and it's the only plan that actually addresses the issue of private loans. However, this plan is widely disregarded in Congress due to a lack of research on future impact of the plan. House Democrat Plan Number 1 is believed to have the most potential to actually pass through Congress. It's the plan that will maintain subsidized rates of 3.4% for the next 2 years. This has the least amount of proposed action. However, it does have the most support within Congress because they believe this will provide them with enough time to come up with a comprehensive student debt crisis plan. I would now like to welcome Daniel to talk about the potential economic implications from this issue.
Hello, my name is Daniel Walker, and I'll be discussing the implications of the national student debt crisis. The current state of student loans is an important place to start when trying to understand the future implications of these loans. Student tuition continues to rise at a rate about 2.5% faster than inflation, and in April of 2012, we saw student loans in the U.S. reach over $1 trillion. We also see many students struggling with debt many years after graduation. Currently, about 14% of loans are past due, accounting for around $85 billion of this $1 trillion in student loans. In addition, it has been found that about 40% of students will become delinquent on their loans within 5 years. All of these issues and more are leading to poor credit history for young students, especially students coming out of school with large student debts. This Pareto chart shows the proportion of student debt by age group. We see that about 42%, the largest group in this chart, are people holding these loans into their 30s and 40s, up to 50 years old. For most, this is likely up to 20 years after graduation. So we see that these loans are not getting paid off right away, but tend to be held on to for quite a while. Another key piece of information here in this chart is the fact that 17% of these student loans are held by people over 50. Again, this is evidence of the size of the student loans are being typically taken out, and also speaks to how long people are holding on to these loans due to interest rates or poor employment opportunities after graduating from college. Focusing more closely on the impact to the economy, we see the diminished purchasing power of individuals with these student loans. The size and prevalence of these loans has reduced the likelihood of young people to make normal big-ticket purchases and likely had a large impact on the recent downturn of the automobile and housing markets. People being forced to wait longer to buy their first home or car, we are seeing a ripple effect across the entire market. In fact, the proportion of people with home-secured debt has decreased over 10% over the last 4 years for those who hold student debt. While the recent downturn of these markets certainly had multiple causes, we can attribute much of the market stagnation to the reduction of these big-ticket purchases for students with loan debt. We also face a potential issue of retirement ages as increasing as young people are forced to put their income towards these increasing student debts rather than retirement accounts. As students coming out of school have large financial obligations to their student debts, which are gaining high interest rates, they are less likely to put money towards retirement accounts, which will impact them only in the future whereas these student loans have a big impact on them now. The risk that has probably the most worrisome implications is the default of these student debts. Tuition prices continue to rise and loan interest rates are not kept in check. We face a very real possibility of these loans beginning to default. This would have a tremendous impact on the economy, as likely similar to the recent crash we have seen in the housing market. As we discussed previously, the political actions which have been discussed in the House of Representatives and Senate will likely have a huge impact on the future risk of loan default, which would have an enormous impact on the economic well-being of the young people of this current age.
The recent credit crisis. Group members: Justin Lau, Katie Faulds, Kenny Parsley. The overview shows topics we plan to discuss regarding the recent credit crisis. We will begin with an abstract or introduction, then jump into the background, the impact on financial markets, the global effect, the government response, how the economy was able to stabilize, and finally conclude with sentiments of financial markets. The history of crashes goes back a ways to 1873, when speculation arose in the railroad industry. Many years later, in 1929, the infamous Black Tuesday occurred, due to speculation in steel, automobiles, and wheat. In 1987, the stock market crashed again, when automatic or program trading began and removed the human decision-making element out of the equation. Then came the dot-com crash of the late 90s, due to speculation of internet startups and value, leading to the most recent crash, the financial crash of 2008, driven by speculation in the real estate industry and investment banking. The common theme being that during all stock market crashes, individuals ignored business fundamentals and either speculated or tried to find shortcuts. For example, algorithmic trading. The stage for the recent credit crisis was set in the wake of the dot-com bubble in 2001. Following the aftermath of the dot-com bubble, the Feds feared that the economy would head into a depression. In order to promote growth during that time of need, the Treasury decided to decrease the interest rate on Treasury bonds, thereby opening the floodgates of liquidity and cheap credit into the economy. This led to an increase in borrowers taking out loans to fulfill long dreams of owning a home. Because of the increased demand of home mortgages, property values began to climb, and since Treasury bonds yielded such low returns, investors began to seek securities with higher returns. Investment bankers took notice of this and began to buy up profitable mortgages from home lenders, consolidate them into securities called collateralized debt obligations, or CDOs, and sell them to investors. At this point, the whole process became a vicious cycle. Investors wanted more CDOs because of the returns we're bringing, and when investment bankers bought more mortgages from home lenders, lenders were enticed to make more home loans. This works well when mortgages are given to individuals who can afford the mortgages, but because responsibility of the loans were sold to investment banks, home lenders no longer felt the need to screen home buyers. This led to a slew of subprime mortgages flooding the market. To further emphasize the problem, these toxic CDOs were being rated AAA, highest rating a security can receive. Because of the rapid increase in real estate values, this allowed insurance companies such as AIG to insure the securities using credit default swaps. At this point, the bubble is at its bursting point, and the stage is set for the financial crisis of 2008. The 2008 recession was the worst recession the country had gone through in the last 50 years. The recession posted more than a 5% fall in real GDP for the country. 8.8 million jobs were lost, and $19.2 trillion were also lost in household wealth. The first signs of trouble began in Europe, August 9th of 2007. BNP Paribas blocked withdrawals from 3 hedge funds, citing a lack of liquidity. This was followed quickly by a bank run on a British bank known as Northern Rock, after they requested financial security from the Bank of England. In 2008, the financial crisis hits the shores of the U.S. and signaled the rapid demise of Wall Street banks. A few of the major financial institutions affected by the financial crisis are Bear Stearns, Lehman Brothers, Merrill Lynch, Fannie Mae, Freddie Mac, Washington Mutual, Wachovia, Citigroup, AIG. While the precursors of the crash occurred up to a year prior, the peak of the crisis occurred in the months surrounding September of 2008. The bankruptcy of these Wall Street icons sent shockwaves throughout the world, and panic began to set in. In the wake of the financial crisis of 2008, the Dow Jones Industrial Average went from a peak position of 14,000 in October of 2007 to a trough of 6,600 in March of 2009, resulting in a 53% decline in market valuation. This has often been compared to a similar drop during the Great Depression that resulted in a 54% drop. In the end, it is estimated that $2.6 trillion were lost in toxic securities from 2007 to 2010. Europe bore the brunt of the crisis, accounting for $1.6 trillion, while the U.S. accounted for $1 trillion. While the United States suffered a decline in GDP of 6.2%, the exports fell 23.6% and imports fell 16%. A higher impact was felt in emerging market economies such as India and China. Both countries experienced GDP growth, however they both experienced double-digit rate losses in the trade. The major factor in the trade decline can be linked to a breakdown in trade credit. When trading, the producer needs credit to finance production to fill orders until payment is received. Banks may require companies to obtain insurance coverage to cover non-payment in exchange for the credit. The importer faces a risk of goods not being delivered as promised. Trade can be equated to a chain, and the breakdown of credit availability at any link in the chain compromises all parties. During times of financial crisis, the U.S. government has always fell back on the following strategy: lower interest rates, maintain confidence in the safety of the banking system, and lend boldly. This 100-year-old strategy is first mentioned in a book called Lombard Street, A Description of the Money Market, by Walter Bagehot. As quoted, lend freely, boldly, and so that the public may feel you mean to go on lending. Over the years of 2007 through 2009, the government's response was critical and had an impact on many different sectors of the economy, from restarting economic growth to paving the way for retirements to recover to helping unclog the credit pipes of the financial system. A few of the key responses from the U.S. government during this time were passing two significantly large fiscal stimulus packages totaling nearly $1 trillion, the Economic Stimulus Act of 2008 and the American Recovery and Reinvestment Act of 2009. Each were focused on injecting cash into the economy and increasing the flexibility with which institutions could tap such liquidity. Secondly, by purchasing $2.5 trillion of government debt and troubled assets from banks, making it the largest monetary policy action in world history and further stimulating the economy. Next, by lowering the federal funds rate from 5.25% in August of 2007 to 2% in April of 2008, thus providing more liquidity in the financial system. Further, by expanding the range of collateral the central banks would accept in return for loans, and providing direct lines of credit to more financial institutions. And finally, by approving a $700 billion Emergency Economic Stabilization Act of 2008, also known as the Bailout Plan, focused on purchasing distressed assets and supplying cash directly to both foreign and domestic banks. The Emergency Economic Stabilization Act of 2008 was passed on January 3rd, providing the authority to the Treasury Secretary to restore stability and liquidity to the U.S. financial system and ensure the economic well-being of Americans. The bill also established powers to carry out with Troubled Asset Relief Program, also known as TARP. TARP was established to purchase troubled assets from financial institutes and was a multi-pronged approach to revitalize the U.S. economy by stimulating multiple sectors, including, but not limited to, the auto industry, bank investment programs, credit market programs, housing, investment in AIG, and executive compensation. The Automotive Industry Financing Program, AIFP, was created to prevent the collapse of the U.S. auto industry. The threat of industry collapse posed a monumental risk to the stability of the financial market, endangered the country's economy, and would have resulted in the loss of 1 million U.S. jobs. Starting in December of 2008, the program was executed to prevent the uncontrolled liquidation of Chrysler and General Motors by extending temporary loans to both companies and their financing entities. The Treasury invested approximately $80 billion through the AIFP and had recovered almost $51 billion of that as of June 30th, 2013. Conditions of these loans included having long-term viability plans approved by the government. Both Chrysler and GM brought in new management and restructured operations through proceedings in bankruptcy court. These restructurings were the tip of the spear for the company's turnaround and for the rebound of the entire domestic automotive industry. Bank investment programs were instituted to help stabilize the banking system by investing in both large and small banking institutions. There were 5 programs put in place: the Asset Guarantee Program, AGP, Supervisory Capital Assessment Program and Capital Assistance Program, SCAP and CAP, the Capital Purchase Program, CPP, the Community Development Capital Initiative, CDCI, and finally the Targeted Investment Program, TIP. The programs have been highly successful for the U.S. taxpayers, yielding significant positive returns. For the $271 billion invested over the length of the programs, almost all of it has been recovered through repayments and other income. No more taxpayer money is being invested in banks under TARP. The final investment was made in December of 2009. Credit markets were severely struggling when the Obama administration took office. This made it very difficult for small businesses and consumers to get loans. 3 programs were launched to meet the needs of these small businesses and consumers. The Public-Private Investment Program, PPIP, designed to promote market function by investing private capital into the market for legacy securities. The SBA 7A, Securities Purchase Program to unlock credit for small businesses. And finally, the Term Asset-Backed Securities Loan Facility, TALF, launched to aid the asset-backed securitization markets and that provide credit to small businesses and consumers. In regards to the housing programs, the Treasury launched a program called Making Homes Affordable, MHA, as a way to provide mortgage relief and to help prevent avoidable foreclosures for homeowners that qualify for the program. The foundation of the MHA was the Home Affordable Modification Program, HAMP. HAMP helped homeowners by permanently reducing mortgage repayments to more affordable levels for those who qualify. MHA has expanded to also include other mortgage relief programs. The application deadline for the MHA has been extended through December of 2015, so additional homeowners have the time to get the mortgage relief that they need. The Hardest Hit Fund, HHF, was rolled out in the states that were the hardest hit by large home price declines and high unemployment in the recession. This allowed for foreclosure prevention solutions to be customized based on the needs of the area. The government identified that a failure of AIG would have been catastrophic to the economy and the financial system. Investment was made into AIG by the Federal Reserve and the Treasury in an attempt to prevent the chaotic failure of AIG. A total restructuring plan was developed in a joint venture by the Treasury, the Federal Reserve Board in New York, and AIG to fully repay the taxpayers and to restore the financial condition of AIG. In total, $182 billion were invested by the Federal Reserve and Treasury, and an overall positive return of $22.7 billion was realized. The Treasury realized $5 billion and the Federal Reserve the remaining positive return of $17.7 billion. In December of 2012, the final sale of AIG shares was announced by the Treasury. Finally, for executive compensation, the Emergency Economic Stabilization Act and Treasury issued the interim final rule for TARP standards for compensation and corporate governance IFR to ensure that financial institutes that were receiving exceptional assistance through TARP programs were structuring executive compensation payouts in a means that was beneficial, reasonable, and in the best interests of shareholders and taxpayers. The Office of the Special Master was established to oversee the structure and payout of executive compensation. All of the requirements outlined in IFR need to be met while participating in the TARP program and until all obligations are fully satisfied. To recap the government's wide sweeping effect, this visual reference, sourced from the U.S. Department of the Treasury, helps paint a clear picture of just how many different sections of the economy the government was able to positively impact. In addition, the U.S. Department of the Treasury also produced this chart, overlaying a few key investments, decisions, and programs during the financial crisis with the real gross domestic product broken down quarterly. In summary, the Treasury Department, in partnership with the Federal Reserve and other federal agencies, were able to stabilize the economy so that families could meet their financial needs and businesses could obtain credit enabling growth. The recession was officially declared over in June of 2009, and by January of 2010, the U.S. government had recovered most of the money spent on banks. In other sectors, such as mortgages, auto loans, and credit cards, the government has done equally as well and recovered 99% of the money injected into the economy. However, many still fear that the fundamental changes that need to happen to the banking industry and financial markets did not occur, and therefore could lead to another recession. Finally, a few sentiments of financial markets. The financial crisis signaled a new era in the way banks and investors conducted business. Two of these lessons learned were investors' risk appetites and views on liquidity. As investors, banks, and homeowners witnessed the downfall of these Wall Street icons, a noticeable decrease in risk appetite began to permeate throughout the nation. Many banks reined in their lending policies while rating agencies struggled to regain their reputations. Individuals and businesses shifted away from policies of speculation and restored a back-to-the-basics approach. Investment banks dusted off their boots on business fundamentals and moved away from highly leveraged financial strategies. In the years following the crisis, there was such a huge shift in the way risk was viewed that it became nearly impossible to open a line of credit for aspiring homeowners and businesses. In addition to the decrease in risk appetite, there was a shift in the way the nation viewed liquidity. In the years before the crash, it was viewed that a highly leveraged investment bank yielded high returns. But in the years following the crisis, banks started to decrease leveraging and increase cash reserves. Individuals who were hit hard by the crash also began a policy of saving and fiscal responsibility. Emerging from the financial crisis, investors began to view earning potential and leveraging as secondary to liquidity.
Today we will briefly cover a wide range of information related to the management of fixed income investments. We will be discussing basic background information, the types of fixed income securities available, as well as discussing the different management theories. We will conclude by reviewing the applications and strategies that are present in the management of fixed income investments. To continue the discussion about risk, we will briefly discuss the different levels of risk associated with the many types of fixed income securities. Some of the lowest risk securities are those that are backed by large governments, such as treasury bills. Another popular low risk options are bond funds and money market funds, which are low risk due to their diversification of many bonds which reduce exposure to market swings over time. These represent low risk options because it is very unlikely that the issuers will be unable to meet their financial obligations. Moving up the risk scale, in the medium range, we have investment-grade bonds as well as foreign bonds that are issued based on the debt of emerging and developing foreign markets. At the highest level of risk, we have high-yield bonds and corporate bonds. These represent the highest risk based on the ability of their issuer to meet their financial obligations, but also the highest yield when they do.
Since most securities are traded regularly on the open market, we have to analyze yield. or the internal rate of return. Yield is the required interest rate you would need in order to equal the current market price at maturity. A more applicable term for a security's yield value is yield to maturity, since it is greatly influenced by the remaining duration till maturity. To more accurately determine a bond's price, we utilize both present value and annuity formulas from the previous slide to derive the bond price formula. This formula considers the market yield, which is denoted by lambda. A bond's price goes up only if yield goes down. So, it is a good thing for a bondholder when the yield or prevailing interest rate decreases, because this means that the price that people would be willing to pay for your bond increases. You can see this in the formula by noticing that yield, or lambda, is always in the denominator. For a graphical depiction of the relationship between the yield and maturity, we refer to the yield curve. The yield curve can help provide investors the current prediction of future economic conditions. The graphs shown are examples of general curve types that have been encountered in the market. The curve on the left represents a normal curve, which depicts an anticipation of economic growth with inflation. The next graph is a flat curve, which represents uncertainty of the future economy. The third graph shows an inverted curve, which forecasts economic recession. The last graph shows a humped yield curve, which anticipates both economic growth and recession during different times in the bond's duration. Another curve we use to analyze security investments is the price-yield curve. This curve describes the interest rate risk associated with a bond. In other words, it shows how sensitive a bond's price is to change in yield. This curve helps us to see the amount of influence the duration, or time to maturity, has on the interest rate risk. For example, let's focus on the option-free curve shown on this slide. For this curve, longer maturity bonds have higher interest rate risk, thus they have more curvature. A shorter maturity bond would be less curved than the one shown and would be easier to predict because there is less uncertainty or risk. Options in the purchase agreement of a bond could also alter the shape of the price-yield curve, as you can see with the call and put option represented by the red and blue sections of the graph. Also notice that the steep part of the curve shows that there is more interest rate risk when yields are low. Therefore, buying a long-term security when yields are low would be very risky. Now, the current yield is just a measure of the current annual rate of a bond and is found by dividing the annual coupon payment by the bond price. The duration of a bond is used to give a more direct measure of interest rate sensitivity. For securities that use yield as a measure of market price, the Macaulay duration is used. It measures the average time till the value of a bond is received. The price sensitivity formula shown is derived from the Macaulay duration formulas. It allows you to estimate the change in price due to a small change in yield or vice versa. This formula is derived by taking the derivative of the Macaulay duration price formula with respect to yield. The modified duration, denoted as D sub m, is found by dividing the Macaulay duration by 1 plus the periodic yield. The modified duration is approximately equal to the Macaulay duration for small changes in maturity or yield. The modified duration is important because it gives us the slope of the linear tangent line at a price on the price-yield curve. Therefore, it helps us predict changes in bond price for small changes in yield or maturity. Since the modified duration provides a linear prediction of price change with respect to yield, error increases as the change in yield or duration increases. To account for this error, the convexity approach is used to obtain a more accurate approximation of the price-yield curve. It is obtained by taking the second derivative of the Macaulay duration present value formula, and then this gives us a quadratic term that provides a convex curve that better resembles the actual price-yield curve shown on the graph. Immunization is one of the most important analytical techniques used to manage fixed income portfolios. It helps protect a portfolio's value against interest rate risk. A portfolio can become more immune to interest rate risk by matching the durations and the present values so that the durations of obligations and coupons are due at the same time. For example, if the yield falls, an obligation or payment may be higher than expected. However, if the yield also falls for a held security and the income payment for that security was due at the same time as the obligation, the changes in price would offset each other. Therefore, immunization provides protection against changes in yield. This analytical tool is often utilized by institutions such as insurance companies or pension funds to offset their recurring obligations. It is important to note that after a change in yield is experienced, the portfolio must be rebalanced to the new yield in order to maintain immunity.
Moving on to management applications and strategies, there are three types of management strategies we are going to discuss in our presentation today. They are fixed income ladder, barbell, and bullet strategies. Fixed income ladder is a portfolio of systematically chosen fixed income securities with staggered maturity dates. The basic idea behind a laddering technique is to create a portfolio of securities structured in a way that a portion of the portfolio is getting matured and is available for reinvestment at regular intervals. As shown in the table on the slide, there is a sample fixed income ladder example. In the hypothetical example below, there is $60,000 invested in 3 bonds with different maturities and yields in year 1. In year 2, the investor rolls the proceeds from bond A into a 4th bond, which is bond D. In year 3, the investor rolls the proceeds from bond B into a 5th bond, which is bond D. And there are multiple advantages of fixed income ladder, and some of them are periodic. So one of them is periodic return of principal, provides additional investment flexibility. Basically, the idea here is the proceeds received from the principal and interest payment can be invested in additional bonds if interest rates are relatively high, or in other securities if they are relatively low. Another advantage is the proceeds received from principal and interest payments can be invested in additional bonds if interest rates are relatively high, or in other securities if they are relatively low. Okay, next one is the barbell strategy. Barbell strategy is the kind of investment strategy in which investment is made in short and long terms bond, but not in intermediate duration bonds. This particular strategy is similar to laddering strategy, except that it emphasizes on having a mix in portfolio with maturation dates at opposite ends of the spectrum. This strategy is particularly useful in case of rising interest rates, as it is short-term securities receive higher interest rates as they mature and roll over. The main advantages of these strategies are as listed here on the slide. The first is this strategy allows investors to take advantage of rates when they are high without limiting their financial flexibility. Next one is it provides liquidity to make large purchases or respond to emergencies. Because of a portion of the assets are invested in securities that mature every few years, basically what he says is one has the necessary liquidity to make large purchases or respond to emergencies. And the last but not least, it reduces the risk associated with rising interest rates. Basically what he's saying is allocating only part of the mixed income portfolio in longer term bonds that can help reduce the risk associated with rising rates, which tend to have a greater impact on the value of longer maturities. The last one is bullet strategy. Bullet strategy is sort of opposite of barbell investment strategy. Bullet strategy is based on the premise of creating a portfolio of different types of securities with intermediate durations over an extended period of time, but with all the securities maturing around the same time frame. Bullet strategy allows the investor to minimize the impact of fluctuating interest rates while still maximizing the return on their investment. And there are a couple of key advantages of these strategies. First of them is it provides sufficient funds to finance the purchase. What it means is all bonds mature at roughly the same time, ensuring you have sufficient funds to finance your purchase. The next one is it helps hedge interest rate risk. And how it does is by buying bonds at different times and during different interest rate environments. Basically, this strategy allows hedging interest rate risk. Thank you.
In conclusion, fixed income investments and securities offer a wide array of flexible options for investors to add to their portfolios, such as government-issued treasury bills to corporate bonds to bond funds. These have multiple management methods to address the needs of multiple types of investors with respect to time, risk, and return on investment. They also offer a reduction in both short and long-term risk as compared to other assets or equity investments through the reduction of exposure to market fluctuations.